Hello and welcome to the latest edition of the Purple Sofa podcast with myself, Andy Steele.
And I'm Sophie Holmes.
One of the questions we get asked about a lot at 360 is with regards to property disposal declarations. So that's what we're going to be talking about today. So Sophie, what is a property disposal declaration?
So anybody that is disposing of a property in addition to their principal residence, so not the home they live in, it might be an investment property, it might be a rental property, but any other property that they are disposing of, they need to complete a property disposal declaration. So these were brought in a couple of years ago by HMRC. What used to happen was if you sold a property during a tax year, you would declare that on your annual tax return and you would pay the tax the following January. In order to ensure that properties were getting recorded correctly, disposals were getting declared, ultimately the correct tax was being paid over, HMRC brought in these declarations. So now you have to declare the sale of the property within 60 days of the completion date. And as well as completing the declaration, you've also got to have paid the liability as well, which is quite a key thing now because it's not just getting the form in, it's also making sure that that payment goes in as well on time.
It used to be 30 days, didn't it?
Yeah.
But they've relaxed that slightly and it's now 60 days.
Yeah, it is quite onerous getting all that information together. So just that extra little bit of time just made it a little bit easier for people, yeah.
I think one of the reasons they brought this in was to stop people who were perhaps retiring abroad, selling their assets and then clearing off without paying all of the due tax, etc.
Yeah, if you sold your property on the 30th of April, you wouldn't be declaring it until after the 5th of April the following year. And then you had until the following January to pay that tax. So it could potentially be over 18 months in some instances before HMRC were collecting that.
And a lot can happen in that time, can't it?
Yeah, a lot can change.
People can die, disappear, etc.
Yeah.
Just to be clear, it's only residential property, isn't it? It's not commercial.
Yes. Yeah, that's correct.
Yeah. So you pay the capital gains tax around the same time that you make the declaration.
Yeah.
And then,
so it's key to get the form in as soon as you can, because if you're submitting the form on the 60-day deadline, you've got to make that payment as well. And depending on how much that tax bill is, you might not be able to make that full payment in one day. So then you're going past the deadline, which HMRC could impose interest on.
So in terms of calculating the gain?
So there's a few things to look at. And obviously it can't be done until after the completion date. So that's the first key thing to think about. So when you do the declaration, you need to obviously know the property that you are selling, so the address and where it is. And
if you don't know that, you've got a problem, haven't you?
yeah, it's probably a good start to know that. So you initially need the purchase price of the property, and that could be 20, 30, 40 years ago, even longer in some instances. So you have the original purchase price and any costs you incurred at that time that you didn't expense through your tax return. So if you paid stamp duty, legal fees, any fees to estate agents, you would include those within the purchase price. So people that have purchased properties years ago need to have kept hold of those records. You then have your sales price, which you get from your completion statement, but you can also then deduct off any costs you've incurred with selling the property. So again, any estate agent's fees, valuation fees, anything else you've had to incur at that point. So you start with your sales price, take off your purchase price and any costs with buying or selling. The other thing that you can deduct off as well is any capital expenditure that you have spent on the property over the life of having it. So that might be renovations that you've done to the property over time. And it's anything that you haven't expensed via your tax return. So if it's already been claimed and you've had the tax relief in the year that you incurred the expenditure, you couldn't then incur it again at this point. But anything you haven't incurred and you've kept the records for, you deduct off.
So that would be things like an extension,
Yeah,
changing wooden windows to UPVC double glazing.
absolutely. You might have you might have upgraded boiler systems and things over that time. So any items you can deduct off, and that will give you the profit that you have made on the sale of that property. Once you've got the profit, then you work out the tax that is due. And what HMRC asks you is, what is your income going to be for the rest of that tax year, to work out whether you're a basic or higher rate taxpayer. And it can be quite tricky, because if you sell the property in April and you're perhaps self-employed, you might not know what your income's going to be for another 11 months.
Even if you're employed, you might not know, because you could change jobs.
Yeah.
It could be a fixed term contract.
Yeah, absolutely. There's so many variables that HMRC ask for an estimate. And I suppose getting your tax return done for the previous year would help, because it would give you some indication of what that might be. So if your income is within the basic rate band, you would pay tax at 18%. And if your income is in the higher rate, you would pay tax at the higher rate. But it's not all or nothing at the basic or higher rate. You use up the rest of your basic rate band. So at the moment, that limit is 50,270. So if your income was 40,000, you would pay 10,000 at the basic rate, and the rest would fall into the higher rate. So it does use your income to work out how much that tax is going to be.
Yeah, it's a bit complicated, isn't it?
It is.
And so the higher rate of capital gains tax on the sale of residential property is now 24%, isn't it?
Yeah.
It was 28%.
Yeah. And you do also get your capital gains exemption off that as well.
Which is a huge £3,000.
Yes. It's not the amounts it used to be, and it's going down again next year. So it's not a huge amount. But if the property was owned by more than one person, so if it was a person and their spouse and it was 50-50, they would both have to do declarations within that time frame, declare the 50% of the profits, but be able to use their capital gains exemption each if they've not already used it in that year.
Yeah, so normal capital gains tax is 10 and 20%, isn't it? Depending on whether you're basic rate or higher rate. But there's a 8% surcharge on residential property, although the 8% surcharge has been halved to 4% as of the current tax year, which was so the current Conservative government have been attacking landlords for the last few years, haven't they? They've reduced the amount of costs you're able to claim against your income with regards to interest.
Interest, yeah.
They brought in the 8% surcharge on capital gains tax. So the reduction from 28 to 24% was presumably an attempt to win the votes of landlords. Whether that will be enough, time will tell. Yeah. I suspect not.
So when it comes to the end of the tax year and you're preparing your tax return for the year that has just passed, you do still have to include that property disposal on your tax return, because what happens at that point is the tax return, whether you do it yourself, whether you outsource it to an accountant like ourselves, we work out what your actual income was for that year. And then we recalculate the property disposal to work out if the tax that was paid within the 60 days was the correct amount. Because as I started off by saying, it's based on your estimated income originally. And when you've got your actual, you then know the final amount of tax. And at that point with your tax return, you settle any additional amounts that need to be paid.
So how can 360 help individuals that are either thinking of selling a residential property or have recently?
So Lisa Powell, who is our personal tax manager, she completes all of our property disposals for our clients. We do them electronically so that they get to HMRC quicker, rather than waiting for the post, so that they can be processed within the correct time frame. She also double checks what is being claimed to make sure that you're claiming the correct things, you've not missed anything out. She also, when it comes to the end of year tax returns, does that recalculation to make sure that the tax was correct and any underpayments are being declared over at the right times.
Okay, so if anyone has any questions about property disposal declarations, they can either contact us on help@360accountants.co.uk or contact us through our social media outlets, which include LinkedIn, Instagram, Facebook and Twitter/X. Thank you.